We'll start.
So do I need to click on start?
No, I am doing.
Okay.
So good evening to all of you. Today we'll be having our 26th webinar of the Vasudhaiva Kutumbakam series. And today's topic is some anomalies of BRSR reporting. And we have with us CA Kishore Parekh sir. Before we start the webinar, we start with our institute anthem.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय.
Today we have with us CA Kishore Parekh. Sir is a fellow member of the Institute of Chartered Accountants of India. His advisory prowess also extends to corporate where his insights are valued. He is having a certificate in IFRS from the Institute of Chartered Accountants of India and has completed the diploma in IFRS from ACCA UK. In a span of numerous years, Sir Parekh has immersed himself in catalyzing environment, social, and governance initiatives that resonate with India Incorporated. His dedicated involvement is evident in his collaboration with entities embracing the business responsibility and sustainability reporting, that is BRSR framework, as mandated by the esteemed SEBI. This involves his adeptness in designing, executing, and curating disclosures to ensure adherence to BRSR. As an outstanding academician for over 3.5 decades, he has imparted his knowledge to a vast array of professionals and corporate entities, enlightening them about BRSR. Additionally, his sagacious guidance has proven invaluable to listed companies, enabling them to align with global reporting standards such as Global Reporting Initiative. The depth of his expertise extends to presenting scholarly papers before the discerning eyes of the Office of the Comptroller and Auditor General of India, as well as the esteemed officers of public enterprises under the Ministry of Industries in India. This attests to his profound influence in matters of financial and reporting significance. A special invitee to the Sustainability Reporting Standard Board of ICAI, Sir's insights and opinions are held in high regard. His membership in the India's Implementation Transition Group of ICAI, along with his contributions to the Expert Advisory Committee of ICAI, further underscores his commitment to driving excellence. As a visiting faculty at numerous prestigious professional platforms, Sir has imparted his wisdom on subjects spanning ESG, BRSR, INDES, IFRS, and other related reporting frameworks, leaving an indelible mark on the landscape on financial reporting and sustainable practices. Sir is also an author of ESG and BRSR reporting published by Taxman. With this, I welcome Sir Parekh sir to start his presentation. Over to you, sir.
Thank you very much for giving an introduction and giving me an opportunity to share my knowledge with the deputed platform of ICA Institute of Cost and Management Accountant. Now, as you know, the subject is very new. It is upcoming subjects. So first of all, the awareness of the subject is not with the professional I have observed. Even in our chartered accountant profession also, I have met many chartered accountants. They are not aware of the ESG and BRSR reporting. Now it is a demand and requirement of the time. As you look at the environmental position which is happening over the globe, so the World Conference and everybody has come to know to take necessary actions against the environment. And with that, we will take it, what are the problems, what are the challenges, and what are the anomalies we have to face by preparing the report on BRSR reporting. So now let us refer to the slide.
So you can show your slide, sir.
It visible? If it is visible.
Yeah, visible, sir.
Is it visible?
Yes, it's visible, sir. Yeah, you can go ahead, sir.
Introduction to ESG and BRSR reporting. See, what is ESG? It includes environment and social governance. It is a guidance and qualitative assessment of sustainability. So what environment includes? Air pollution, water management, greenhouse gases, energy consumption, waste generation and disposal, and there are so many other items also, like an e-waste also to be taken. So e-waste is also a part of environmental. Social, employee health and safety, employee training, CSR, shareholders engagement, human rights and including gender equality. Governance, related party disclosures, statutory compliance, policy of SOP, grievances, principal redressal, and board commitments to ESG. Now, how it has come into the existence? At the initial level, it was taken as a BRR reporting only. There is business responsibility reporting. It was applicable to 100 listed companies. Over a period of time, in 22-23, it has come out with BRNSR, that is business responsibility and sustainable reporting, which is applicable to the top 1,000 listed companies by market capitalization. That is very important. And that is applicable from 22-23. Now the framework is prepared by NGBRC, that is National Guidance on Responsible Business Conduct. There are 9 principles which are covered in reporting. The goal is very clear. You have to show BRSR initiative to comply with the non-financial disclosures. That means whatever the annual report which comes out, it covers now 2 elements. Number 1, financial reporting, that is profit and loss account, balance sheet, etc. In addition to that, non-financial reporting, we call it as a business responsibility and sustainable reporting. That has become mandatory to 1,000 companies. Disclosures, the disclosure mandated by ARSR calls the data GHG, green emissions, greenhouse gas emissions, energy use, shareholder complaints, risk possibility under each of the ESG elements, and also for an identification of stakeholder. So this is very important. It also includes a value chain partner. Now, challenges which we have to face for the preparing of the report. First of all, the biggest challenge that what I have observed on practically also in many companies, there is a data collection. What do the data requires to prepare a ESG reporting? That is particularly social report, governance, and environmental. So if you look at the 9 principles, it covers all. So this data collection is very important for each company. And that struggle with the gathering reliable and consistent data. Difficult to ensure accuracy and comparability. See, when data, because there are so many departments, so many things that they have to collect the data, and that data is very important. And the accuracy of that data, what is the data you are receiving, how much to be relied, what extent it is to be relied, that is equally important for the data collection. This data accuracy issues can undermine the integrity of ESG reports. So entire reporting depends on your data collection. So the first biggest problem, the first challenge is the data collection. Second, ESG compliance burden. Now, as per the local regulations, regional and global ESG regulations. So you have to comply with all the requirement of ESG. See, if you look at the many report, there are different type of report you can get in. One, it is called integrated reporting, and second, BRSR reporting. When you look at the integrated reporting, it is nothing but ESG reporting, but it covers all the aspects. So there is global regulations and everything that is to be taken by considering the ESG reporting. That which often differs in their scope, reporting standards, and deadlines. This creates a significant administrative load as a business must allocate resources to ensure compliance with this framework. These compliance burdens can lead to inefficiency, increased cost, and potential legal risk. See, the compliance of BRSR reporting, the requirement of BRSR reporting, it looks very easy if you go through the looking it, but when you go into the depth, it becomes very difficult to collect everything. And then the complexity of ESG regulations is equally important. That is also to be taken into the consideration. Measuring ESG performance effectively. Measuring ESG performance effectively is a major challenge for organizations, primarily due to the lack of standardized metrics and frameworks. See, the different type of industries have a different type of metrics. Frameworks are concerned, there are different frameworks also for ESG and BRSR reporting. So which is to be considered, that is very important. ESG factors are complex, multi-phase, and making it difficult to quantify and track performance. See, once you prepare the report, whatever the emissions data that you have taken into the current year, or let us say in 22-23, how much is the increase in 23-24? How much is the decrease? That performance that is to be checked. And based on that, your reporting will be taken into the consideration by the stakeholder. That align with the specific business context, with the addressing the full spectrum of environmental, social, and governance aspects. This can lead to an incomplete or inconsistent reporting making. The data required for accurate measurement is often a fragment or a difficult to obtain, especially for the non-financial metrics like social impact or government practices. See, once the company has gone for the social, now they are going to form the factory in area X. Now in area X, all the persons residing by it will be affected by this situation of the factory. That factory will create emissions, and that emissions will affect to the nearby people. So now it is very difficult to estimate that it is quantified how much people are affected and to what extent they are affected. When the CO2 is produced by the factory into the area, it is affecting not only to the human being, it affects to the animals also, it affects to the trees and others also. So that effects will be also taken into the consideration, that is the performance. So when you do this, how it is performed, what action you have taken, and after taking the action, what is the result out of it, that is equally important. High cost of ESG implementation. The high cost of ESG implementation presents a significant change for many organizations, particularly smaller business or those in capital intensive industries. Integrating ESG practices what requires substantial investment in new technology, process improvement, staff training, and compliance measures. See, once a company has decided to go for a BRSR reporting, then the persons who are preparing the BRSR reporting in the company, there should be specialized people. They should be aware what is the required and what is not required. So you cannot give the data, huge data, but a data which is given, it must have some sense, it must have some useful data. That making only quantitative data is not equally important. How much correctness of the data is, that is very important. What is the process they are following? How it is done? Then investment in the new technology, staff training, and compliance measures. See, chartered accountant can go over an audit, he can do the financials, etc. Cost accountant can go for the finding of the costing and cost audit. Now for this type of implementation of reporting, there is no specific qualification given anywhere. So the staff should be trained for the purpose of reporting. For example, transition to the more sustainable production process, adopting a renewable energy source or implementing comprehensive reporting system can be financially burdensome. This upfront cost can determine companies from pursuing or fully committing to ESG initiatives. Ongoing costs related to monitoring, reporting, and maintaining ESG standards can add to the financial strain. Smaller companies in a particular may struggle or allocate the necessary resources for robust ESG efforts while balancing other business priorities. As I have mentioned, that awareness and skilled workforce is the biggest challenge in ESG reporting. Even as on today, many companies are not aware of the BRSR reporting. Even management, even their audit committee, independent directors who are the responsible for this, they must have awareness of ESG. Why it is required, what is ESG, what benefits are there, it is equally important. And secondly, skilled workforce. That means persons who are working on this project must have a clear understanding of ESG concept. What environment covers, what social covers, and what governance covers. So there should be totally clear-cut understanding between the staff who are preparing for this. This gap in knowledge can result in a limited engagement with ESG goals, making it difficult to align individual actions. Shortage of professionals with specialized skills in this area, like sustainable finance, climate risk assessment, and social impact measurement, which can delay or hinder the adoption of a comprehensive ESG strategy. Without skilled workforce and proper awareness, companies may struggle to integrate ESG principles into their day-to-day operations or report accurately on their ESG performance. This can lead to inefficient decision-making, missed opportunity. There are a number of side effects on this if it is not properly done. Employees are equipped with the right knowledge and skills are essential to embedding the ESG into the company's operational and assuring long-term successes. Difficulties in linking ESG to financial performance are a significant challenge for many organizations. As the connection between a sustainable practice and profitability is not always immediately apparent. While the long-term benefits of ESG initiatives such as improved brand reputation, risk management, etc., is to be taken into consideration. See how environment impact comes to your start or financial reporting also. There are so many accounting standards which will be implicated because of the climate change, because of the environment. Say, for example, if there's an earthquake or there's heavy rain, so it will impact your plant and machinery, then you have to go for an impairment. You will not be able to make the production for 3 to 4 months. That will impact your profitability. If there is an earthquake, the same result will be there. There are so many things. Because of the heavy rain in a particular area, your inventory will be destroyed, which will impact your profitability. So your financial performance is also connected with your ESG, that is environment, difficulty in linking. So struggle to quantify the direct return on investment from ESG activities. See, you cannot take the judgment properly. When there is an effect of the ESG, if there is a suppose the company is not complying with the requirement of workers, laborers, etc., then they have to pay the penalty. It impacts on the production. When it impacts the production, it impacts to your profitability also. So there are so many challenges which are covered under this. The challenge is further complicated by varying ways in which different industries and companies define and measures. ESG performance leading to inconsistency, etc. To overcome this barrier, organizations need to develop clear framework for assessing the financial impact of ESG. invest in data analytics to track long-term benefit and communicate the value of sustainable practice in terms of both financial and non-financial returns. See, renewable energy and non-renewable energy. Now, when you take it for a renewable energy, then what that reduces your cost of electricity also, and which always impact your profitability. What is the return you are getting by the investment into that solar and other energy? That what your electricity produced by solar, that reduces the cost also, electricity cost also, and your return also. So that is also to be calculated by the company as and when required by ESG. Inconsistent reporting formats, that is the first anomalies. ESG reports are often submitted in varying formats such as PDF, XBRL, and others, leading to discrepancy in how data is presented. Further, the lack of standardization makes it challenging to compare ESG performance across different organizations, sectors, or a time period. Now, I give you a very simple example. There are 4 companies which are going in a textile, A, B, C, D. All are using their BRSR reporting. But how it will be comparable among 4? It is quite possible the company A, they may be generating more CO2. Quite possible company D may not be generating adjustment which is generated by A. So in a same industry, there are no parameters, standard parameters for making the ESG reporting. What was the format is a standard format which is used by all the companies. Even manufacturer of chemical also, they will use the same. Manufacturer of textile also use the same. So, but it is very difficult to come to know the standard that what is required. Because there is no standard framework like BRSR report for each industries. Some reports derive from standardized framework like the BRSR format, which complicates accurate assessment and comparison. Format is there, but comparison, how to do it with the 2 industry. What is the production capacity of the different industry, the same type of industry, textile, A, B, C, D, a capacity of production of A is different than the capacity of production B. Now, because of capacity of production, it impacts your environmental impact. Generation of CO2, it also employment, benefit to the employment, everything. Then critical CSG data may be overlooked or misrepresented when reports don't follow a uniform structure. All the industries must follow the standard structure of ESG reporting. See, if the company follows only integrated reporting and they are not preparing BRSR reporting, it is covered under 1,000 companies capitalization wise. They prepare only integrated, they are not preparing BRSR reporting. BRSR reporting has become mandatory and they prepare integrated reporting also. So what happens? Whatever covered in BRSR reporting, they have to give the reference of page of integrated reporting also. What is the facility given to the workers or whatever the covered under the different principle, that reference should follow into the integrated reporting. Some companies are not doing integrated reporting, only giving BRSR reporting. So it is very difficult to compare with the 2. What are the ESG disclosures? To approach analysis, comparability, transparency, and credibility, making ESG data more reliable, accessible to stakeholder. Stakeholder means all, not only the shareholders. Debtors, creditors, neighbors, public, government, everybody is called as stakeholders. See, in case of financial reporting, the persons who are financing, they are more affected. Shareholders are affected generally. Investors are affected. But when you come to ESG, not only investors and shareholders are affected. It is affecting to the public at a large. Your governance part, a social part, it is affecting the company at a large. So that should be also a comparable within the same type of industries. Lack of data verification. Inadequate verification process results in ESG data that may be inaccurate, incomplete, or unreliable. Whatever the data is collected for the presentation of reporting, if those data are not verified, is not checked, then it is possible it may be inaccurate also, it may be not even reliable also, or it may be incomplete also. So data verification is also anomalies. The absence of proper validation mechanism accompanies the integrity and credibility of ESG reports, raising concerns among the stakeholders. If there is no proper validation and mechanism, that whatever the data which is collected is not accurate, not correct, then it affects to the integrity and character of ESG report. And if the ESG report is affected, it affects to the all stakeholders, concerned stakeholders. Without verification, discrepancies or misreported, information can go unnoticed, leading to a potential irregularity or reputational risk. If verification is not done properly, if there is discrepancy in the report, if it is not properly reported, item number X is reported in item number Y, or there are certain important reporting which is required is unnoticed, it is overlooked, then what will happen? Then he will be responsible for any penalty by the government also, regulatory body, and that will also impact to the reputation of the company. Investors and regulators rely on ESG disclosures for decision making, and unreliable data can weaken trust in the company's commitment. It is correct. If your data is not reliable, who will trust you? What were the commitments you are making? Who will trust your commitment? And that will impact your investors and to the regulators also. Implementing internal validation checks and engaging third-party assurance providers can enhance the accuracy and reliability of reported data. See, there are two things: internal validation and external third-party assurance. Either you go for internal audit for the purpose of safety or for the purpose of accuracy, and then you get it assurance. When the assurance is given for the BRSR reporting, that means there is a reliability on the report. People can trust it, investor can trust it on that. Strengthening verification process ensures transparency, builds stakeholder confidence, and reinforces the company's ESG credibility. So verification process is equally important for the purpose of ESG. Variations in the depth and comprehensive of disclosed data across companies create inconsistency that hinders effective benchmarking and comparison. The absence of third-party verification raises concerns about the accuracy and reliability of reported ESG data, leading to the potential mistakes among the shareholders. See, I have gone through many BRSR reporting. For first 150 companies or 250 companies, it has become mandatory for assurance from the current year, from the previous year also. So all 1,000 capitalization companies are not covered under assurance. It takes time, slow by year it comes. So it's quite possible the company covers under the assurance X company doing the business of a chemical, manufacturing X or Y product. A Y company manufacturing the same product. It's also a chemical company. But their BRS report is not no assurance because it is not covered now. So the person or who the investor or a stakeholder look into the BRSR report of the same chemical company, same product, everything is same. There's a lot of difference. Because of verification of the documents, because of the verification of the figures and numbers which are covered under that. Qualitative information which is given in the reporting, that differs. So the quality of verification is properly taken into the consideration. Companies should standardize data collection and reporting practice to ensure consistency, accuracy, and alignment with recognized framework. Engaging third-party assurance providers and strengthening internal verification can enhance data creditability, building stakeholder trust, and reinforcing ESG programs. See, now the recent amendment has come into the reporting also. Previously, there was an assurance to be given for the BRS reporting. Now it has come to the assurance or assessment and assurance. Assessment, they have used the word assessment of BRSR reporting and assurance of BRS, but it has a lot of difference. In certain cases, the company can give the assurance, and certain companies, the company will give the assistance. So that has recently come into the recent 24-25. It will be applicable from 25 while preparing the assurance report. In certain cases, there is a reasonable assurance. In certain cases, there is limited assurance. When you go to the core 9, they have said that should be reasonable assurance. And other case, you have to give limited assurance. Now, question comes over here: how to rely quality of the assurance? In certain, you are giving 9 reasonable. In certain, you are giving. So that is to be judgment which is taken. That which data is more important and which is more effective data. With the core, they have very clearly mentioned you have to give the reasonable assurance, and in other case, you have to give limited assurance. So it makes a lot of difference between reasonable and assurance. So that covers the quality and verification of the data, that which type of assurance should be given. Challenges in data utilization. Differences in data units, metrics across ESG reports create significant challenges. In interpreting and analyzing information, as a stakeholder must reconcile varying measurement standards to derive meaningful insights. Evaluation of reporting format over time further complicates trend analysis, making it difficult to track a company's ESG performance consistently across different periods. These challenges hinder the ability of investors, regulators, and other stakeholders to make well-informed decisions based on reliable and comparable data. To overcome this, companies should adopt standardized metrics and uniform ESG reporting, ensuring consistency across interframes and alignment with establishment frameworks. Additionally, maintaining a structured and uniform reporting approach over time can facilitate seamless trend analysis, enabling better evaluation of long term. See, standardized metrics. The standardized metrics depends on the nature of industry. Different industry have different standardized metrics. If it is more labor-oriented industry, there will be more workforce. There will impact to the employee returns and everywhere. So metrics which are given into the BRSR reporting, it should be standard report. So it should be comparable between 3 or 4 companies. And consistency should be there. Standard. Additionally, maintaining a structured and uniform reporting approach over a time can facilitate seamless trend analysis, enabling better evaluation of a long-term ESG performance. Metrics in ESG reports are frequently presented in inconsistent units. See, this is our also a common experience for the metrics. Energy consumption reported. In certain companies, they are reporting on kilowatt. In certain companies, they are reporting in gigajoules. Now, in reporting, this kilowatt is compared with the turnover. Gigawatt is also compared with the turnover. Now, the same type of two industries, they are reporting kilowatt and they are reporting gigawatts. So, if you look at the generation of CO2 and other emissions, which will differ. So, stakeholder will be confused. Out of this company, which is generating more emissions, because there is a kilowatt and here it is a gigawatts. So, it is not a standard even anywhere. So there is a unit difference in metrics which is there into this reporting. The lack of standardization in units make it difficult for stakeholders to compare data across organizations or sectors accurately. Correct. Variation in unit reporting can lead to a misinterpretation of ESG performance, impacting decision making for investors and regulators. Standardizing the reporting of metrics in universally recognized units can address the issue and improve data comparability. Adopting established framework like BRSR, which specifies unit requirement for disclosure, can further enhance consistency and creditability in ESG reporting. Materiality assessment. It is very, very, very important in preparing the ESG. See, there are so many items which are covered in ESG reporting. If you look at the 9 principles, qualitative information, quantitative information, water treatment, waste, recycling, emissions, employee benefit, disabled people working, male, female, percentage, there are so many things. Now, while preparing the report, out of this, which is more material, that is very important. The material items should be always reported. That is a principle applicable in financial reporting also. If the materiality is not taken into the consideration, because the materiality impacts more on your working and the financial on your reporting. So how to assess materiality? See, there are no formulas. There are no standards to determine materiality. You can say X is better than Y, X is more required than Y. Then this materiality is very subjective. It depends on the decision to be taken by the management, as well as by preparing the BRSR reporting team, and also by the team who give the assurance on that. What are the principles they have laid down? What are the framework they have considered? What aspects they have taken into consideration for taking the item as a materiality? See, without materiality, as if you're not taken materiality assessment, then everything you will take into the report and it will be huge. Nobody would like to read it also, which will not give the desired result also. But the item which is affecting to the reporting more to the company, that is material, should be taken into assessment. This lack of focus results in reporting that is broad and generic rather than addressing critical ESG issues that matter to stakeholders. Without a materiality assessment, companies risk overlooking key risks and opportunities, reducing the effectiveness of their sustainability strategies. A structured materiality assessment helps identify and highlights ESG topics that have the most significant financial, environmental, and social implications. Particularly waste generation, recycling generation, how much water you consume. See, that depends on the nature of industry. There are certain industries which totally depends on the water, chemical industry. There are so many. So the consumption of water, the sources of water is very important. It is considered material. Because the entire industry is dependent on the water consumption. So that is very important, that how much it will impact on your financial as well as environmental. There are certain industries which are, let us say, plastic industries, manufacture plastic product. From granules, they are manufacturing plastic products. So granules are raw material. Then again, that raw material should be whatever comes out of that wastage. That wastage is important. It is recycled. And again, it is taken into use. So that recycling process, the recycling reuse, that is to be taken very carefully. So normally that process that is recycled, and if it is increasing the volume of wastage into that, then it should be taken assessment. Ensuring that disclosures are based on the material ESG factors enhance transparency, stakeholder trust, and the overall credibility of ESG reporting. Transparency. Any report you make, it must be transparent. Nothing should be hidden. Or nothing should be presented in such a way that there must have two meanings. Yes or no. So it should be transparent. Companies face increasing pressure from stakeholders, including investors, customers, employees, and regulators, to meet ESG expectations for transparency, accountability, and sustainability. Failure to address stakeholder concern in ESG reports can result in a disclosure that lack relevance, potentially damaging trust and reputation standing. Very important. Limited engagement with the stakeholders such as investors and communities can lead to missed opportunities for aligning sustainability effort with key expectations. Competing interests among stakeholders such as financial performance versus sustainability demands make it challenges to balance priorities while meeting ESG goals. Insufficient stakeholder involvement can weaken transparency and undermine the creditability of ESG disclosures. Proactively engaging with stakeholders and incorporating their concerns into ESG strategies ensures more meaningful, credible, and improved sustainability reporting. Non-compliance with regulations. Companies sometimes fail to align their ESG disclosure with established reporting standards and regulatory requirements. Non-compliance with ESG guidelines can result in a regulatory scrutiny, penalties, or legal challenges. Yes. If the company has not complied with the requirement of emissions, If the company has not complied with the requirement of disposal of waste, if the company has not complied with the disposal of wasted water, if the company has not complied with the requirement of employees, requirement provident fund, etc., then they have to pay the penalty and as well the legal challenge. We know the case Bhopal gas leakage case, which has happened in 1984. Thousands of people have died. That is because of the non-compliance of the legal requirement in the industry. So the non-compliance with regulations may change the penalty, legal challenge, even it can be imprisonment also. Depends. Inconsistent adherence to reporting norms may lead to a gap in disclosures, reducing transparency and credibility. Inconsistency. That means whatever you give this year, next year you give the same thing in a different form. Third year there is no consistency in the same. That means your credibility will impact. Inconsistent adherence to the reporting norms. You have to maintain consistency. You cannot change every now and then. What is the number of employees and male and female is given? What records you have taken? How it is calculated? Same consistency should be maintained. What is the labor contractor you appointed, the number of persons in that? That also to be taken into the consideration. Then inconsistent adherence to reporting norms may lead to gaps in disclosure, reducing transparency and credibility. Failure to comply can also damage a company's reputation, affecting investor confidence and stakeholders. If the company is not paying a provident fund or statutory dues to the employees, it impacts the revenue impact. So the new employee will think twice to join the company. If the failure to comply with the regulation for the other items, CSR they are not doing, then they have to pay the penalty. Regular monitoring of evolving ESG regulations and aligning reports with mandated framework can help mitigate compliance risk. Strengthening internal governance and audit mechanism ensures accuracy, accountability, and adherence to ESG reporting obligation. See, internal governance and audit mechanism. So there can be two. Internal governance means internal control of the company on SOP. And audit mechanism, that is internal audit mechanism. That means check by check. Document prepared by one should be checked by others. Like that way, that should be internal control, and which will give the better result for the purpose of preparing the report. Outdated reporting practices. ESG reports often rely on outdated data, failing to incorporate recent updates, regulatory changes, or sustainability improvements. See, many companies report I have seen. There were changes in the report of 23-24. 4.9 was included in 23-24. But many companies have prepared the report based on the 22-23. Outdated data. Outdated reporting. Recent updates are not taken into consideration. Now in 24-25 also there are so many changes which has come up. So those changes are to be taken into the consideration while preparing the report. See, you should not depend now, as see in many companies I've seen the previous business copy and paste, copy and paste, copy and paste. So that copy and paste system you do, but be careful whether it is in accordance with the present updation or not. Regulatory changes. Static reporting practice limits the liability to show cause progress, making ESG report appear stringent to or ineffective. Without real-time or periodic updates, stakeholders may struggle to assess the company's ongoing commitment to sustainability. See, periodic updates. I mean, what were the changes which are coming in the reporting are to be taken into the consideration. Outdated disclosures can lead to missed opportunities in demonstrating leadership in ESG performance. So you're not making changes or your data are outdated. And when the investor comes to know that you will not invest the money into your company, funding will not be there. Stakeholders are affected. Implementing dynamic reporting mechanism such as a periodic updates or a digital ESG dashboard can enhance transparency and relevance. Regularly updating ESG disclosures ensures reports remain accurate, reactive current reports, and align with the evolving expectations. Now, this is very important. Navigating multiple ESG frameworks. Now, at a global level, there is no standard framework for reporting. There are multiple. See, if you look at India, if I have to report under the financial reporting, there's an IND AS, Indian Accounting Standard, applicable to listed companies more than that as per the criteria. Now, Global Reporting Initiative, then Standard Accounting Sustainability Standard Board, Sustainability Accounting Standard Board, and TCFD, Task Force on Climate Reporting. Inconsistent reporting making it difficult to compare ESG performance across companies and industries. Companies must navigate varying and sometimes conflicting regulations, complementing both regulatory compliance and ESG. I have seen many reports. I have prepared the reports also and gone through the BR study. Many good companies are giving and comparing the BR reporting each principle with GRI, Global Reporting Initiative. This Global Reporting Initiative board, they have issued Global Reporting Initiative, which is normally accepted by most of the countries. Now this GRI, again it is prepared as the Sustainable Development Goal. With the framework. For BRSR reporting is covering all sustainable development goals. There are 17 goals. And GRI also consists of 17 goals. It means that globally, whatever the sustainable development goals, the content of that should be covered in GRI as well as our BRSR reporting. Sustainable Accounting Standard Board has also issued their standards. International Accounting Foundation, IFRS, and they have also come out with the International Accounting Standards also. Now they have come out with the sustainable accounting standard, international sustainable accounting standard. But I have gone through all the standards, but the standards does not give the full requirement. GRI, it gives full details. SSB is give the guidance, what you should cover, comparative reliability, etc. Blah blah blah. And task force on climate change, that gives it what criteria should be taken in case of a climate change, emissions and others. Now there is no standard format anywhere described by the country. So different countries are following the different standard. We are following BRSR, UK they are following GRI, America is following different TCFD. So there is no consistency into the framework. Companies must navigate varying and sometimes conflicting regulatory compliance and ESG disclosures. Investors struggle to assess companies' sustainability performance, and business face challenges in benchmarking against global best practice or attracting the international investors. See, global investors, foreign funding. Nowadays, I have seen many foreign funding, they are first asking whether you are complying with the BRSR or ESG or not. We do comply, BRSR, but we will also look into the depth, whether that compliance of BRSR is in accordance with the global standard or not. Because we are not preparing at the global standard. We are preparing BRS reporting efficiency format by the SEBI. It covers all. So he will also see whether the standard this report is covered, whether it is linkage with GRI or not. So that is very much important for consideration the framework. Different reporting metrics and methodologies raises concern about data quality. The slow progress towards harmonizing frameworks create outgoing difficulties in achieving transparency in ESG reporting. Adopting an integrated reporting IRC, International Integrated Reporting Council. They have come out with the integrated reporting, and consulting experts can help streamline ESG disclosures and ensure compliance with multiple. Now, IRC is complete different institution, International Integrity Council. They have come up with the integrated reporting. Now, all the companies are not following integrated reporting. It is an option. There are 6 or 7 parameters. They are given financial capital, human capital, industrial capital. What you are doing for that, it is given. And whatever you report on the integrated reporting, but as far as India is concerned, you can give the reference in your BRSR reporting also. So there will not be a double work. The absence of a unified ESG framework also creates confusion among stakeholders, as they may encounter different metrics and methodologies depending on the company or industry handling the assessment. See, my personal experience I have seen in case of foreign funding. If they want funding from the India, then what were the accounts they are prepared in India, they ask them to convert into IFRS. And then they go for funding. Same principle will be applicable over here. When you prepare BRSR report and go for a foreign funding, then you will ask that whether all GRI is compliant or not. Whether there is a proper linkage you have given or not. So this is a very anomalous in case of a framework also. Companies often face challenges in understanding and keeping up with evolving ESG regulations, which frequently changes based on global and regional development. Navigating compliance becomes more complex when different jurisdictions impose varying requirements, creating difficulties for multinational organizations. The risk of non-compliance increases when regulatory updates are not systematically monitored. Adhering to the multiple frameworks while ensuring alignment with the country-specific mandates requires. Establish a robust compliance framework with regular regulatory linking. And leveraging digital compliance tool and automated reporting system can enhance efficiency, ensuring timing. See, this is very equally important. Aligning ESG with business strategy. You have to create a brand. You have to reduce the risk, reputation, etc. Many companies struggle to integrate ESG into the core business operations, treating it as a separate function either than embedding it into a strategic decision. Misalignment between ESG initiatives and business goals can limit long-term value creation and reduce the impact of sustainability efforts. Demonstrating the financial benefits of ESG remains challenging, as advantages like risk reduction, brand reputation, and efficiency gains may not yield immediate returns. See, if you are complying with all requirements of ESG, the product which you are manufacturing, then it will be purchased by the people. If they come to know that this company is ESG compliance, so they will prefer to buy your product rather than other product because you are ESG compliance. Risk is there and brand reputation is increasing, efficiency gains and not be immediate return. With proper integration, ESG initiative risk being viewed as a compliance driven rather than a strategic. Strong leadership commitments, cross-functional collaboration, and embedding ESG into key performance metrics and essential for effective integration. Align ESG goals with the financial outcome enhances stakeholder confidence. And number is one more. Ensuring transparency and accuracy. Maintaining consistency in ESG disclosure is a challenging, as it was discussed in the previous slide. As a variation in data sources and reporting practice can lead to discrepancies. See, sometimes it happens, we have seen practically also. While calculating number of workers employed, some companies have not taken the contractors into the consideration. And most of the companies are doing the work through the contractors only to avoid other legal requirement. Inconsistent or unclear reporting increases the risk of misinterpretation, reducing stakeholders' trust in the company's strategic content. Correct. The potential for misinterpretation or omission of critical ESG information can arise due to inadequate verification or unintentional bias in reporting. Lack of transparency may result in regular scrutiny, reputational risk, and weaken investor confidence. Implementing standardized reporting framework and third-party audits can enhance the accuracy and reliability of ESG disclosure. That is true. Till the assurance will not become the mandatory, it will be very difficult to trust any report published by the BRSR. Because the accuracy and the numbers which are given, metrics, are correct or not. Whether it is in accordance with the documents or not, that is equally important. So clear documentation, internal control, and robust government practice ensures transparency, improving creditability and stakeholder engagement. Inconsistent scope across value chain. It is very, very, very anomalous. Value chain partners. a company is purchasing the raw material from the different vendors. Company is selling the product to the different distributors and different consumers. That is called as the upstream and downstream activity. So all the vendors and all the suppliers, customers are called as a value chain partner. You are engaging the logistic transporters, the contractors is also value chain partner. Now it was mandatory to report value chain partner from 24-25. Now recently it is extended for 1 year more, 25-26. So from the next year, all the companies has to report value chain partner, how much they are generating emissions and other things. What is the requirement of BRSR? Certain area will be covered in value chain partner reporting. So it will be a very huge scope. And they have said that they have covered in upstream and downstream 2% of the suppliers and purchases. Out of 100%, if there are 20% or if there are 30 suppliers who are supplying more than 2%, then they are covered under value chain partner. Supplier supplying 1%, that supplier will not be covered under value chain partner. Previously it was 75%, now they have gone down to, in this way, 2%. If you are buying the raw material from different vendor, but it is below 2% of each vendor, then you will not be covered under value chain partner. Then the value chain partner has to also prepare a value report. A companies may struggle to obtain reliable ESG data from suppliers, logistic partners, and other stakeholders affecting the company. See, value chain partners are the small people, small factory, small manufacturer. They are not a qualified staff, that they can't afford it. They have no understanding of the reporting mechanism. But it will be a duty of the company who is reporting BRSR report, whether these people have done a value chain partners. So without comprehensive approach, ESG risk related to sourcing, production, and distribution may go unaddressed. Establishing clear ESG expectations for value chain partners and integrating them into the reporting framework. Strengthening collaboration and data sharing mechanism ensure a more holistic and transparent ESG assessment. See, still there is no guidance has come how the value chain partner report should be taken. Whether it should be incorporated in BRSR reporting of the company or it should be shown separately of a reporting company, and the same they will show separately or value chain partners. How much they are generating waste, how much they are generating, what is they are doing for employees, but they will not cover the full BRSR, but certain important aspects they will come with the guideline and what is to be covered and what is not to be covered. See, this is a tremendous problem everywhere. There is a greenwashing risk. I am giving you a product. In a plastic bag. I am giving another plastic items. Or in the plastic bag, I am giving another item, or in the cloth, I am giving another item. I'm in the plastic bag or in the plastic packing, big packaging, I am giving the plastic covers, small covers for sale. And I write on the plastic cover that it is a environmental free. But what about the package in which I have taken this plastic cover? Whether that plastic package, big package, is environmental free or not. Or you write it on the package itself, it's an environmental free product. Then what I have to understand, whether the plastic covers which are put it into the plastic package, they are environmental free, or this only package is environmental free. It is a whitewash, green whitewash. You create an image that is an environmental free, but it is not that. So greenwashing tactics such as exaggerated claims about product sustainability, carbon neutrality, or ethical sourcing practice without sufficient evidence to support these assertions can mislead consumers and investors. In a product, food product, they write environmental free. But what environmental free? Is the packing covered in the plastic, or the food which is in the plastic cover, that is environmental free. So there is no guidance. It's a total greenwashing. People will say, oh, it's a very good product. They have written on the product, it is environmental free. But what about the packing they have covered? If the packing is of a plastic, if the plastic packing is environmental free, or the product inside is environmental free. So greenwashing risk is there. The absence of stringent auditing and verification increase the risk of undetected misleading claims. Misrepresentation of ESG efforts can lead to a reputational damage. Investors and regulators are placing greater scrutiny on ESG disclosures, emphasizing the need for transparency and data-backed reporting. Businesses must ensure accountability through third-party verification, reviews, governance, and alignment with recognized ESG. See, this is one aspect I have seen in some companies. Other than this, a company is manufacturing 3 to 4 products. Chemical product they are manufacturing. One company only, one entity only. They are in chemical also. And they are in construction also. There were 3 segments. Now, while preparing BRSR report, as a company as a whole, you will take consumption of CO2 or generation of CO2 and other item emissions of all the 3 or 4 segments. Chemical also, textile also, construction also, if there is another side. Now, in such cases, it will be very difficult to identify whether the chemical plant is generating more emissions or construction activities generating more emissions or textile activities generating more emissions. It will be very difficult to compare with the other company which is manufacturing chemical. So there is no specific guideline given anywhere that if the company is having a different segment, then the data should be given by segment wise and then consolidated. There is no guidance. And as on today, it is consolidated. It is also part of the greenwashing. Poor alignment with an SDG goal. Sustainable development goals. That is also to be taken into consideration. So while preparing BRSR report, you have to align, you have to give the with the which SDG goal is applicable in which principle. Linkage, that is called as a linkage. Linkage with SDG goal as well as the linkage with GRI. Without proper alignment, companies may miss opportunity to explore how that will fail. The absence of well-defined links to SDG can reduce the effectiveness of ESG disclosure, including. See, if the linkage is given properly with SDG and GRI, your reporting will become more transparent. That reporting will have a value. Investor cannot ignore it. Stakeholder cannot ignore it. Because you have covered GRI also, you have covered ESG companies. But in your BRS reporting, if you have not given, no, I think 95 of the companies are not giving any linkage as on today. It may be more, not less than that. For companies which are globally operating, they have companies that are subsidiaries in other countries, they do give. But the most of the companies I have observed not giving. The absence of well-defined link of risk can reduce the effectiveness. Stakeholders, including investors and policymakers, increasingly expect companies establishing a structured approach to map ESG initiative to relevant SDG, enhance transparency and accountability. Clear reporting on SDG alignment help this position. Limited focus on social metrics. ESG reports often prioritize environmental, government metrics while social aspects, such as human rights, diversity, etc. Lack of detailed social disclosures create an imbalance. Making it difficult to assess companies' overall sustainable performance. Investors and regulators are increasing emphasizing social impact, making comprehensive disclosure essential for creditability. Strengthening data collection reporting on a social aspects ensures more holistic approach to ESG transparency. Since considered social aspect, mainly they are considered CSR. Whether the CSR done is properly or not, whether it is going to the right people or not, that is very important. All human rights are covered, that is human diversity. That means there should not be any diversity in the company. For male and female, there should not be that. Everything should be taken equal. All rights are given equally. Everything to be taken into the consideration. Or emphasis on quantitative metrics. ESG reports often prioritize numerous data which without qualitative context can make it difficult to interpret. Absence of case studies, real world examples or qualitative insights can make reports feel impersonal and less engaging. A balanced approach that integrates both qualitative and quantitative, it is very, very important. Any report should be based in qualitative as well as quantitative. And my observation, quantitative will get it, but qualitative report is very few companies are giving. And very few companies are giving the good quality, they are long in writing long stories. In qualitative storytelling, but that is true or transparent or not, that is very important. A well-structured report combining data-driven insight with meaningful narrative. Many companies still rely on manual process for ESG data. As on today, now many companies are coming out with the software. Because the ESG has come recently, so they are developing the software for each company also. And that software should be connected with the financial reporting also. When I have to find out emissions or generation of electricity, number of units I can get it from, bill raised by the insurance or electricity company. So it should be aligned with the financial reporting also. The absence of advanced tools and automation platform difficult to ensure accuracy, consistency, and real time. And that is true. Without digital solutions, integrated ESG data approach departure and value chain partners becomes complex. Implementing technology-driven ESG reporting system enhance efficiency, reduce human error, and improve. Leveraging AI, artificial intelligence data analysis. See, there is the biggest problem in AI. I collect the information from AI, but what is the correctness? How much it is correct? What is the authenticated of report? That is very important. ESG disclosure ensuring a more transparent and rigorous reporting framework. ESG reports often emphasize short-term achievements, overlooking long-term sustainability. Without clear future target, reports may appear repeated rather than proactive. Investors and regulators increasingly expect companies to outline long-term ESG strategies. Integrating both short-term processes and long-term plans enhance transparency. A well-balanced ESG report that includes future outlook, scenario planning, and sustainability roadmap strengthens. Challenges in benchmarking. See, so long there is no benchmark for any item which is given into the ESG reporting. Total inconsistency for a benchmarking. Each company will have a different benchmark, but there is no standard benchmark. Inconsistent ESG reporting metrics across companies create challenging company performance industry benchmark. That each industry, textile industry, what are the benchmark that they have to give this much, they have to create only this much emission, they have to generate only this much water generation, they have to generate only this many scrap. There is no benchmark. Industry-wise, there are no benchmark given. So the lack of benchmark is a challenge. The lack of standardized data points is challenge. Without clear benchmarking, companies may struggle to identify gaps, set realistic targets. Investors and stakeholders rely on benchmarking to evaluate ESG leaderships. Aligning disclosure with recognized ESG framework enhances consistency and practice. Establishing industry-wide standard, adopting common reporting. Challenges and ESG anomalies. What is the difference? Definition. Broad systematic issues that organizations face with implementing ESG principles. Anomalies, irregularities, inconsistency on deviation from expected ESG reporting or performance standards. Ongoing difficulties, nature, and make ESG implementation complex. Errors, gaps, or misleading data in ESG reporting. Focus barriers that prevent companies from effective adopted ESG framework. Specific issue in data accuracy, etc. How to address requires long-term strategic improvements, better regulation, ESG, etc. Requires immediate corrective action. Example, lack of standardized ESG framework. Companies struggle with different ESG standards like GRI, SASB, and TASB. Inconsistent carbon emissions data. A company reports different carbon emissions, etc. See, this is the difference between ESG anomalies and challenges. Thank you very much for patience listening. It needs more time. Actually, the time is constrained. It takes 2 to 3 hours, 3 hours minimum. But I have tried my level best. I hope you must have taken well. Thank you very much.
Thank you, sir. I think you did a wonderful job of touching all the anomalies of BRSR reporting, and we are very much thankful for your wonderful presentation. Sir, one or two questions have come just to highlight green funding. Member has asked us, can you please share what are the kind of funding available for green funding and whether they are cheaper compared to the normal funding? So can you
funding depends on the nature of industry. Emissions creation funding, that is, suppose if a company wants to go for a solar now, correct? Then there is a specific green funding is now creating now many companies. So they are good. And nominal funding, other funding is of a different nature. So green funding has come out with a new concept. When you construct the building or glass, everything, you change it solar panel, everything. So they are coming with the green funding finance. So that is a different than the normal funding finance. Normal funding is quite different, but now the people are concentrating on green funding finance more. So any further question you may write on my mail. and then I can reply to you. One minute can write any questions to you and reply the same way.
Okay, okay. Definitely, sir. Okay, with this, we close today's session. I thank wholeheartedly uh, Parekh sir for his wonderful presentation. And we will be just highlighting 2, 3 initiatives of our Sustainability Standard Board. We are starting with the third batch of the ESG certificate course. Uh, I think tomorrow is the last date. From Sunday onwards, our third batch starts. The first batch examination has already been done and we have completed the assessment. And second batch exam is on 23rd of this month. We are also having our 19th issue of Sukhino Bhavantu, our monthly newsletter. And we request everybody to just give your inputs on the Sukhino Bhavantu. We are starting with 2, 3 new columns. Please give your feedback so that we can improve our activities. And also, we would be very soon starting with our Green Awards. Green Awards for the best companies. We have segregated in 4 categories. We will be updating in our various information channels. And with this, we thank our chairman, CMA Dr. Ashish P. Thatte sir, our president and vice president, and all the SSB board members for their continuous support. We thank Dr. Ranjit Krishnan sir, who has helped us with connecting with Kishore Parekh sir. And we also thank all our administrative support staff who has made this webinar possible. We will be having our next webinar on 28th February. And with this, we close today's session. Thank you, sir.
Thank you very much.